What's going on, everyone? It's Sean from Predicting Alpha, and today we're going to be going over a stock that is very dear to my heart, Aurora Cannabis. Aurora Cannabis is a stock that I was extremely bullish on for a number of years back in the day when I first started trading, and I went through the entire roller coaster with them. I had them when they were a couple dollars, I rode it all the way up to $15, took some profit, and then joined them for that entire journey back down to 70 cents. And if you take a look, Aurora Cannabis has had quite the journey over the last 5 years, right? I picked them up somewhere around here, and they jumped all the way up. These are post stock split numbers, so they went from $20 all the way up to like $103. And in the last year, they got absolutely pummeled, down 94% from May of 2019 to May of 2020. But in the last few days, it looks like Aurora Cannabis might be turning a new leaf here, and actually. But in the last few days, it looks like Aurora Cannabis might be turning a new leaf here and starting a new chapter in this crazy journey that they've had as a stock, as they've gone up in value 200% in the last week alone. All started with them releasing earnings last week and extremely surprising on their revenue numbers, up 35% from the last quarter's returns. Now, Aurora Cannabis still hasn't really made money. They're still operating with a negative return, but this rapid increase in revenue growth drove the stock price up like crazy. So if we go to the options terminal quickly and we look at the earnings trader for ACB, we can see here that in the last earnings event, the market was implying a 18% move up or down depending on the results from the earnings event. And that's not too surprising to see such a high expected move on an event, especially with everything happening with COVID and the market being so volatile these days. Totally makes sense why 18% would be expected. But then ACB came out and they actually moved 68% on the day of the earnings release. They moved 4 times more, almost 4 times as much as what the market thought they were going to. And this is something that I could not believe when I saw it. If you had bought options around this event, you would have made an absolute killing. But what was even more surprising is that after the earnings event, they continued to trend upwards. So much so that today they are actually up another 57% so far. So what's the trade here? As options traders, when we see a situation like this, we need to be thinking to ourselves, where is the trade right now? Knowing that there is all this volatility, that the stock price has changed so drastically in the last short period of time, that means that there is definitely some opportunity within the market for us to be trading options. Remember, options are volatility products, so the more that things are moving, the more opportunity there tends to be to trade options. So to start off my analysis of options trading, I always follow a 3-step process. The first step is that I look for an inefficiency in the market. The second step is that I try to understand that inefficiency. And then the third step is I structure a trade to take advantage of that inefficiency. So let's start with the first step, finding an inefficiency. When we look for inefficiencies in options, what we're really looking for is a mispricing of the options. So we want to see an option that's selling for $10 that's really worth $5, because then we can go out and we can sell it for $10, knowing that we'll likely be able to buy it back in the future for $5 and keep the spread as profit. Or on the other side, we want to find options that are trading for $5 that are really worth $10. We'll buy them today and hopefully be able to sell them in the future for $10 and capture the spread once again. And when I look at Aurora Cannabis, I can see a very clear pricing inefficiency here. Where is this coming from? It is coming from the implied volatility by the market. So what we can see here when we look at Aurora Cannabis, right away, the implied volatility is extremely high. What this means is that the market thinks that in the next year, Aurora Cannabis is going to move 284% up or down. And if we do a bit of math, right, let's open up our calculator here. We can say that the market is implying a 17.75% move per day for Aurora Cannabis. Now, this is a really high move, right? Like if we think about it, that's a lot for a stock to be moving in such a short period of time. But it's not enough to just look at that number and say, okay, that's way too big of a move. It can't do that. We need to have something to compare it to. So what we do is using all of these factors on the side here, we create our own Predicting Alpha forecast of what volatility will be in the future. And what we can see here is that our forecast is half that of the market implied volatility. The market implies 284% move over the next year, and we're thinking there's going to be a 141% move over the next year. So doing our quick math again, right? We do 141 divided by 16. So the market thought that the stock was going to move 17.75% per day, where we think it's only going to move 8.8% per day. So now we can see a very clear pricing inefficiency here. We can see that the options are extremely expensive. So what that means is if we wanted to structure a trade, we could sell options here, collect a really big premium, and probably be able to keep it because the odds of the stock moving enough to outweigh the cost of the premium that people pay for the options is not likely. But before we can go ahead and structure a trade, we need to understand why this inefficiency is there. Now, I looked through a lot of the news and there was nothing I could see in the news alone that really dictated to me why the implied volatility would be so high. Sure, we had some good news at the earnings, and yes, they're set up pretty good for growth in the future. But now that we already know that information, why is the volatility staying high? Shouldn't the price have corrected to account for the future growth and then things return a bit back to normal? Well, that's what I actually think is going to happen, but we still need to understand why the implied volatility is so high. So to understand this, I had to move away from just the news and start to look at who could be on the other side of my trade. Who is driving all this demand for the options that's propping up the implied volatility? And when I look at the retail market, it becomes pretty clear to me that the retail sentiment is increasing rapidly. A ton of people are looking at this stock, and there is a lot of trading happening around it. So let's take a look at a couple of factors that indicated to me that the retail traders are probably buying the options right now and that it's safe to be selling it to them. So the first thing I looked at is the retail sentiment. So looking on StockTwits at Aurora Cannabis, we can see that there is 72,000 watchers. So there's a lot of people looking at the stock just to start off. When we look at the sentiment, it tells us are people more bullish or bearish on this? And what we can see here is that the retail traders are extremely bullish on this stock. Just earlier today, this number was at 64%. And in the last couple hours, it's shot up 8% to 72.32%. So what we can see is that not only was it already bullish, they are becoming more bullish about this stock. And when we can say, oh, but what if there's just like less people looking at it, only the bulls are looking at it? Well, the message volume has increased almost 10 times in the last week alone. Around May 7th, there was only 1,500 messages being sent about ACB. And in the last week, that has shot up to an average of 10,000 messages being sent about ACB. So there are more people looking at it, more people engaged with it. They're getting more bullish. And then now we need to take a look at the option chain to see where are they buying. And when we can understand that, now we can go ahead and confidently place our trades because we'll know who's there, we'll know what they're buying, and we'll know why the implied volatility is as high as it is. So coming back to the predicting alpha terminal, there's a couple more things we want to look at to really solidify our view that it's retail traders driving the demand for this stock. And the two things that we're going to look at to do that is the relative action and the skew. So when I look at the relative action here, what this tells me is how many people are trading this stock right now relative to how many people trade it on an average day. And when we look at this bar, we can see that it is a 10 out of 10. So what this means is relative to how many people trade this stock on a daily basis, this is as high as it gets. There is a ton of people trading this thing right now. And this confirms my view that there's a major increase in the number of retail traders that are looking at this stock right now. The second thing that I look at in the terminal is the skew. And what this tells me here is that for the short dated options, the demand is literally through the roof, like an unbelievable amount of demand. I've never seen this much in so long, right? For the 10-day options, it's implying a 310% volatility. So here for the next 30 days, over the next year, the average implied volatility is 284%. And when we go extremely short dated, it's implying over 300%. So this once again confirms my view that there's a lot of people buying the options up around this, keeping the price inflated, the action is really high, and the retail sentiment is extremely bullish. So all of this indicates to me that there's a good chance a retail trader is on the other side of my trade if I go to sell options here. So now that I know what the inefficiency is, why it's likely to be there, I can move on to step 3 and structure a trade to take advantage of this crazy amount of volatility around ACB. So to show you how we structured a trade on this, I'm going to pass it off to my partner Jordan, who's going to show you exactly what we did to structure a trade around ACB that we think is going to pay off massively for us over the next few days.
Okay everyone, so we're going to go look at the actual structure of our trade and how we can profit from all of this high implied volatility. So Currently, I'm in my thinkorswim platform, and ACB is trading at $18. You can see right over here, $17.87. So we only have a 16 strike on the high end. So what we're going to do here is we're going to sell a straddle. We're going to right click to analyze that trade. Here's the current position, the option position that we have. Now, the problem with this position is it's leaning negative deltas, meaning that we make money if the stock goes down and we lose money if the stock goes up. So we kind of want to be neutral on direction. So what we need to do here is we need, for every one lot that we, so let's turn this into a one lot. For every one lot that we sell, we need to buy 30 shares. So now our position looks like this. So here we are neutral on direction at inception, where our break evens are 26 to the upside and $11 to the downside. So this is the trade that we have on right now, and we're going to let this play out for the next couple days. And note, guys, we are selling the May 22nd option. So these are the options expiring this week. All right, I hope that helped, and I'll talk to you in the next video.
So there you have it, everyone. That's our trade analysis for Aurora Cannabis. We just put on a 10-lot trade selling naked straddles. So if you want to see the profit and loss on that trade, follow us on Instagram at Predicting Alpha. We post all of our trade results live on our channel there, and we have a ton more good content for you all. Now, also, if you have any questions about anything covered in this video, leave a comment below. We love talking about this stuff. We'll be happy to get back to you, and we'll see you all in the next video. Take it easy.